Thank you very much. I'm going to talk to you about Asia today, and like the other presenters, I think one of the key things that we all need to focus on when investing are the businesses and the companies that we're buying into. And I think this is particularly true in the context of Asia. Asia, it's a very exciting region. It's a higher growth region from an economic standpoint than the rest of the world, but with that comes volatility. So volatility is generally higher in Asia than other markets, and but that also does mean that markets tend to be a bit more inefficient. And certainly in our view, we think that the best way that we can sort of add value as a manager is to invest for the longer term in quality businesses, very much from a bottom-up perspective. And it is that ability to add value above the index consistently over time that is ultimately where you're going to get your best returns from, and that is very much that fundamental bottom-up approach. So bringing that back to sort of, and that's exactly what I do when managing the Schroder Asia Pacific Fund. And so if we bring that back to what's sort of happening at the moment in Asia, if we look at the last sort of 5 years of performance, how has Asia performed? We've got 3 lines on the chart here. The sort of blue line is that comes out in the middle is Asia. The darker line that goes up to the top is the S&P 500, so the US, and the lighter green line is the FTSE 100. And you can see that basically up until about the end of 2020, Asia was broadly performing in line with the US and outperforming the FTSE, but since then it has lagged, and it's lagged both against the US and the FTSE. So why has that been? I think the main reason for that has been around China, and 2 things in particular there have impacted returns. Firstly, it's around regulation. In China, there's been, as you would have heard, a lot of announcements around regulation in China. And secondly, it's about concern over a slowdown in the economy there, and that has clearly weighed on the market. So if we look at the first of these areas, regulation, what's been happening there? I mean, China has always been an area which has been regulated relatively heavily, particularly around areas such as the financial system. So financial stability, as you can imagine, is a very important focus. So we saw sort of quite a lot of regulation around fintech, for instance, at the end of last year and through this. And so that, I guess, is not that particularly surprising. And also around sort of national security issues. So we've seen quite a lot of regulation around data and so on. What's been new has been really this focus on regulation around sort of big business, and in particular this sort of focus on common prosperity. And I think this has come out of the fact that for a lot of people in China, the costs of living have been rising, and in many cases rising faster than wage growth, and this was having a disproportionate impact on families, family formation, and indeed was in fact even impacting the rate of population growth. And that's the chart that you can see here, which shows the number of newborns in China. You can see, even though actually China's abolished the one-child policy, the population growth has continued to fall. And that, again, comes in part back to this point about the costs of bringing up children has gone up a lot. And so a lot of this regulation has been around trying to rebalance, if you like, the economy away from some of the big business, so some of the internet companies that have been more heavily regulated, towards sort of smaller private businesses, SMEs, but also in favor of labor as well. So to try and address sort of property costs, education costs, we've seen specific measures around reducing the cost of education and also healthcare. And so from an internet perspective, some of the internet companies have been impacted in making sure that they offer the best choice to consumers, and also around the employment of gig workers, a bit like here, making sure that payments around social security and insurance are fully done. So these issues have been weighing on the economy as that sort of wave of regulation has come through, and this focus on common prosperity, you can see here, has really been driven really partly out of what you can see on this chart. China's been great at sort of growing its economy rapidly over the years, and it's done a very good job of lifting the wider population out of extreme poverty, but the spoils of that growth haven't been shared evenly. And here you're looking at income, disposable income from an urban perspective, and you can see that the bottom quintile, which is the blue line, has been growing at a much slower rate than the green line, which is at the top. So the people that have been earning more, doing better, have continued to outpace those at the bottom. And that's what a lot of these policies are about. They're trying to move really from a sort of more of a pyramidal or triangular distribution of income, much more to an olive shaped, if you like. So trying to bring those people up from the bottom, up more into that middle income area. What it's not trying to do is, the regulation is not trying to say everyone should earn the same. It's not about trying to sort of eliminate profitability in the private sector. That's not what is going on here. It's about trying to redistribute the spoils of growth a bit more evenly. Just to finish off on this was just showing the distribution of income that has been urban income, which has obviously been less between the bottom quintile of earners and the top quintile. You can see that the top quintile have done well, and that was all to say there. And so this impact of regulation from an investment standpoint just means that the ability to forecast where earnings and growth are going is that much more difficult, and therefore has weighed on that market. What is happening here? How do you play that fact if regulation has been tough in China? Well, one thing that's definitely happened or will be required going forward is still more semiconductors. Digitalization of China will continue despite what's going on from a regulatory standpoint, as it will globally. So we're going to see increased demand for semiconductors and silicon. Some of the best manufacturers of that are found in Asia, particularly in countries such as Korea and Taiwan. And so there are some real world-class companies in those areas, and they're the sort of businesses that we like to buy and hold within the portfolio. So regulation has clearly been a sort of an issue for people in China, which has weighed on markets. But the other has been really about the sort of potential for a slowdown in China, and in particular related to the sort of economy, property sector. And Evergrande is the company that comes to the forefront there, and the concern over whether that's going to be a sort of Lehman moment, if you like, for China from a property perspective, from an economic perspective. We don't feel that is the case. Evergrande has been well flagged. It has high liabilities, some 300 billion odd, but they've been very well known, and it's a relatively small proportion of the overall pie. The other thing is that China actually, from a property perspective, has been, since the sort of, if you like, the splurge post-global financial crisis, has been actually trying to control growth in China, to reduce excesses, particularly in places like property. They very much they've got this mantra of that, property is not for investment, it's for living. And you can see that from the two charts in the middle, on the middle and the right, where the inventories are relatively low versus history, or certainly not high, and materials intensity has come down since the peak. So policy towards property in China has been tight for a reasonable amount of time. The other advantage that China has, perhaps, which others might not, is that they also operate a closed capital account. So from that perspective, they're able to control things much more tightly, and the state also is very much can control the sort of financial system. The bank has influence over the banks and indeed the state-owned enterprise property sectors. So in our view, less risk around a sort of systemic issue within property. If we go to the next slide, however, there are concerns, that obviously the property market is slowing, and after all, it does make up over a quarter of GDP in China when you consider all the other pieces of the economy that are linked into that. So it's clearly very significant and a risk if growth there was to slow, and prices are coming down and transactions have come down. However, we would expect to continue to see further easing measures coming out of the property sector that we've started to see already, and therefore we believe the slowdown is manageable. The biggest risk, and if we could go to the next slide, is really more around the broader economy slowdown, which obviously property is part of, but a lot of this slowdown is actually deliberately being managed by the authorities there, in the sense of reducing these excesses I was talking about earlier that occurred after the global financial crisis. So trying to rein in those things. And if you look at the right-hand chart here, it's a bit small, but if you look at the green line, this just looks at the sort of credit impulse in China, so sort of how tight or weak monetary policy is there. And you can see that with the line coming down, it has tightened post sort of the relaxation during COVID, and that normally precipitates a slowdown in GDP growth. Interestingly, the most recent data today suggested a stabilization and even a slight pickup or less worse numbers coming out of that side of things, so that we are starting to see easing measures come through. We saw a triple R cut last week or earlier this week, for instance. So in our view, it's actually more about whether the authorities can relax and stimulate the economy as quickly as perhaps they need to avoid the economy slowing down faster than expected, which is the issue. The other area in Asia which has sort of been a concern has been more around COVID, and that's the next slide, which just looks at the vaccination rates across Asia. And if you sort of rewind, and apologies, it's a bit small if you can't read this, but if you rewind back to sort of the middle of this year, vaccination rates in Asia were really quite low versus their history, versus other Western economies. And initially, Asia had done, particularly North Asia, had done a really good job of sort of suppressing COVID, particularly in places like China, but vaccination rates were low. We've now started to see them catch up quite materially, and in some cases are now in excess of that of the UK. So they are catching up there. So hopefully going forward, the drag from COVID and repeated lockdowns should not be quite the issue that it was historically. But clearly, as we know here, there remains quite a lot of volatility about the pace at which economies can open up because of COVID. And it's noticeable that China is probably the last of the major economies that's still looking to sort of maintain a sort of almost a zero sort of approach to COVID. I'm looking at the outlook for just from an earnings expectations. Earnings, like elsewhere globally, have sort of recovered. And if you look at the left-hand chart, this just looks at earnings expectations or earnings growth, and you can see that the light green line has been moving up steadily through the year. It's now sort of over 30% for this year, and it looks up to be the dark blue line has been coming down a bit, so it's about 8% growth for next year in earnings. So earnings growth are coming through. However, revisions, which is the right-hand chart, is not so as positive as it was. And I think part of that is around the fact that costs have been rising for a lot of companies, and that's been coming through in inflation and supply chain concerns. And that's the next slide, which is which just really highlights that. You can see on the left, raw material prices have been going up. In the middle, there's been some shortages, particularly around things like semiconductors. They're starting to alleviate, but still remain. And that has the potential to impact margins for companies going forward. And it comes back to that point made earlier. You know, you want to be in companies that have got pricing power, that are able to push through price rises to recoup any increases in costs. Does look like some Asian companies are able to do that, and the right-hand chart sort of illustrates that. So it's and this is just looking at import prices into China. Into the US from China, and you can see that that has turned quite positive, which suggests that exporters from China into the US are able to recoup some of those cost rises which have been impacting their business. The other thing I think to just highlight, and a concern that there is out there potentially from an Asian perspective, is around sort of tighter monetary policy and the potential for impact of tapering and rising rates will have on Asia. We last saw that really back in 2013. And generally when rates rise, it impacts Asia because it sort of sucks liquidity out of the region, and that tends to negatively impact particularly countries that are running deficits from an external economy perspective. And that's the left-hand chart. You can see, if we look at that as a current account balance as a proxy for that, you can see that the dark blue bars back in 2013 and compare them to where they are today, the green bars for most countries have improved. So we think it's less of an issue this time from a macro perspective. And we'd also point to the fact that on the right, you can see that the balance sheets of companies in Asia, which are the light blue line here, are generally better than other regions globally. And so corporates are in generally good shape. So hopefully any impact from rising rates will be less of an impact than perhaps they were in previous episodes of tightening. However, where we think it'll more likely to play out is on the chart here, which just looks across the different industries by valuation. So it looks at their price earnings and where they are versus history. And you can see that there's some very expensive areas of the market, which tend to be in some of the more sort of higher, longer duration growth names, which perhaps are a bit more thematic in nature. And we think that there's potentially more risk from rising rates on some of those more expensive valuations. Whereas at the other end of the extreme on the left, you can see there's a lot of what you might describe as slightly more economically impacted sectors that are trading much closer to the valuation, to the bottom of the valuation range. And therefore, again, an active approach, I think, here is key in ensuring you're not the types of stocks that you want to buy. The next slide looks at valuations across the region, and you can see that the aggregate valuations have started to improve, whether you look at price to book or price on the left or price earnings on the right. They're still above their long-term averages, but earnings growth has started to come through, and they are less elevated than they were from historically. And if you go to the next slide, you can see that actually valuations versus the rest of the world, so if you look at the price earnings, the forward price earnings against the rest of the world's price earnings as a measure of valuation discount, if you like, you can see on the left-hand chart that's roughly, Asia's roughly just under 30% cheaper on a PE basis. And within certain sectors, such as information technology, and that's, if you look at the right, you can see that, again, the valuation differential there, you've seen IT stocks globally go up and re-rate up. That's been less obvious from an Asian perspective. And then finally, if we go to the final page 16, yeah, thank you. Just really to sort of sum that up in the context of Asia. Asia, as I mentioned at the beginning, is an inefficient market from our perspective, and we think we can add the most value from bottom-up fundamental approach, and so the types of companies that we can buy, we can consistently, hopefully, add value above that of the index. And if you look at the historic performance of the Asia Pacific Fund, what you can see is that that has been the case, and that you can look at the bottom line there. The relative performance per annum over 10 years has been over 3% above that of the index. So there's been a consistent ability to add value through the consistent application of a bottom-up fundamental process, and that's very much about the me as a fund manager drawing on the resources that Schroders has, the sort of, if you like, the 40 analysts that we've got based out in the region who are going out and spending a lot of time visiting companies and writing research and so on. So again, very much believe in that active approach to management as a way to add value over time. And with that, I will finish, and thank you very much.